Good afternoon and welcome to today's webinar. Let me get the slides on the screen. My name is Markus Kuger. I'm the host of today's webinar, Leveraging Non-Financial Data, How Data is Changing Credit. I'm the Chief Economic Advisor here at Baker, and I brought 3 additional presenters with me today. I will go first. I will start with an economic outlook for 2022. Then I will hand over to Sean Rees, who's the Credit Risk and Data Integrity Manager at the VF Corporation. He will talk about relevant intelligence for high value and high risk accounts. Then it's over to Maria Anselmi, Vice President Data Acquisition and Partnerships at Dun & Bradstreet. She'll talk about ESG scoring and payment data. And the final presenter of the day is Paul Randall, who's the CEO of the Credit Info Group. He will cover real-time commercial banking information, how Africa may lead the trend. We will all talk for around 15 to 20 minutes each, which should leave time for Q&A at the end of this slot. If you have questions, please submit them by using the Q&A button in your Zoom application. As said, I will go first. I want to cover 4 topics today. I want to explain to you where we are in the economic cycle. Then, second, I want to explain to you where we are moving towards, what does the future hold. I assume a lot of the audience will work in a credit function, so I want to quickly cover payments performance as well as business failures. And then to tie it back to the overarching topic that we've picked for today's webinar, I want to explain to you what data economists normally use and what new data sources we have uncovered, especially during the pandemic. So I want to talk about alternative data in country risk. But let's start with the economic assessment. And unfortunately, the headwinds are increasing. Things aren't looking too good at the moment. Here on that slide, you can see JP Morgan's global manufacturing PMI. PMI stands for Purchasing Managers Index, which is one of the most widely used surveys that is out there in the economic world. You can see there has been a massive deterioration in 2020. Obviously, that had to do with COVID. Then there was a quick recovery, but for the past 6 to 9 months, optimism in the manufacturing sector globally has been fading again. 1 second, please. Yes, Warren? Warren? Just a question for the others. Can you see my screen? Because apparently you can't. Okay, can you see my screen now?
Yeah.
All right. So we haven't lost a lot. We've only missed a few information, a little bit of information about the running order, but overall, I think we are good to go. I was talking about the PMI, which has been deteriorating for quite some time now. It's not only the PMI that has been deteriorating for a while, it's also the consumer confidence indicators that have been deteriorating. And I've picked the one for the UK, and the UK is of particular interest here because the consumer confidence in the UK is an all-time low at the moment. So not even during Brexit, not even during COVID, not even during the global financial crisis has consumer confidence in the UK been so low as it is now. The question is, why is that? And that has obviously something to do with inflation. Inflation is currently on a 40-year high in the UK. In many other countries, that is also the case. Spain, for example, yesterday has reached double digits. And unfortunately, these inflationary pressures, they are increasingly entrenched. We can see that on the slide here that I've put on the left-hand side. This shows the contribution to the overall inflation rate. At the beginning, when inflation rates picked up 12 months ago, 18 months ago, it was mainly because of oil prices starting to rise. But now you can see that literally every component that is included in the calculation base for inflation is having a positive contribution to inflation. So increasingly, this inflation is entrenched and widespread. Wage growth, unfortunately, isn't as high as inflation, which means that households are losing out. The living standards are falling, and that is having ramifications for consumer confidence. Central banks are responding to this by the usual methods they have, and that is tightening monetary policy, which is a more academic word for saying they're rising interest rates. That is the medicine that is prescribed to arrest these inflationary pressures, but unfortunately that comes with a price, and the price is lower growth. When we look at inflation, there is some tentative good news at the moment, because some commodity prices, they have actually started to fall. Copper is 12% cheaper now than it was 12 months ago. Iron ore, 40% cheaper. Lumber prices are cheaper. So there are several commodities that are now cheaper than they were 12 months ago. Overall, however, and especially when it comes to agri-food, commodity prices are still up. Corn is more expensive. Soybeans are more expensive. Wheat is around 50% more expensive than it was a year ago. Natural gas and oil is also more expensive. But even there is positive news, because when you only look at the last few weeks and months, you see that these prices have started to come down. Wheat, for example, up 50% year on year, but it is now as cheap as it was before Ukraine was invaded by Russia. On the left-hand side here, you see the IMF forecasts that were produced in April. Twice a year, the International Monetary Fund publishes the global outlook. And here are the forecasts that were made in April. You can see that inflation will be significantly above the 2% target that many central banks have. But you can also see that the IMF expects these inflation rates to drop back closer to their 2% target over the next year or 2 years. I think that these inflation forecasts are a bit too optimistic. The next IMF forecast is due in October, and I expect that a lot of these forecasts will be revised upwards. So, but nonetheless, inflation will start to come down. Besides inflation, we talked about that for the last few minutes. We have additional headwinds that are impacting on the global economy. One of them are supply chains. Supply chains are still disrupted. On the left-hand side, you see the global supply chain pressure index, a fairly new concept created by the Federal Reserve a few months ago. And you can see that things have improved over the last few months. China has come out of lockdown, for example. But when you compare it against the pre-COVID times, supply chain stress is still very, very elevated, which makes it harder for companies to source products. We've talked about interest rates already. They are rising, and that is having ramifications for everyone, for governments, for consumers, for companies. Indebtedness has risen over the last 10 to 15 years, basically since the financial crisis. And that is problematic because rolling over debt, servicing debt will become more costly in the next quarters. And besides the economic risk, we have the usual geopolitical problems. There's a war in Ukraine that no one knows when it will end. We have elections in the US, which could probably make policymaking much more complicated for President Biden. And we have a very aggressive policy stance in China. And all of that is adding to the uncertainty and makes it harder for companies to do business. Let's look at payments performance. And overall, the story is a positive one here. Overall, and this is data from Dun & Bradstreet and its worldwide network partners, payments performance in Europe has improved. The average payment delay in Europe has dropped from 14.4 days beyond agreed terms in early 2021 to 13.2 days. So an improvement by 1.2 days within 5 quarters, which is quite a lot. There are some outliers. Payment delays in the Netherlands have gone up, for example, during that period. And in the UK, we've also seen a deterioration in the last 2 quarters. So all in all, there are some outliers, but the overall trend is a positive one. The problem with payments performance data is that it tends to lag the economic cycle, which means that although the economy is tanking, companies are still paying fairly well, but at some stage, this will change. When we look at business failures, the picture is a bit bleaker here, not as positive as when it comes to payments performance. Again, this is another Dun & Bradstreet publication, the Global Bankruptcy Report issued a few weeks ago. 40 countries were included in that, and it's roughly 50-50 split. 50% of the countries covered there, showed more business failures in 2021, and 50% showed less business failures. When we look at the countries that showed more business failures, we see the UK, for example, featuring there, 19% increase, but we also see Spain and Italy. They've seen 40 and 43% increases respectively. But as mentioned, 20 countries, 50% of the study sample, they've shown improvements, so less business failures last year compared with 2020. And we have to keep in mind that 2020 was already a year when there weren't a lot of business failures. We had all sorts of special rules put in place by governments. So coming from a very low level, 2020, the figures dropped in 2021 in countries like France, US, Germany. They've seen drops by around 11 to 15%. So again, the problem here is this is a backward-looking feature. When you ask me what's going to happen this year, next year, I'm less optimistic. I think the increase in interest rates, the slowdown in the economy, as well as a normalization of COVID policies in terms of companies have to repay the loans, for example, at some stage, that is all creating problems for companies. And I think the number of business failures will rise in many more countries this year. My last slide, and then I hand it over to Sean, is about alternative data. I'm an economist, and for all my professional life, I've been mainly dealing with traditional data. Traditional data gets produced by institutions like central banks, Office for National Statistics, the IMF, World Bank, and it mainly deals with macroeconomic information. GDP is the holy grail of economics, gross domestic product, in layman's terms, what gets produced in a country in a certain time period. But we also look at inflation, unemployment rates, corporate earnings, for example, features there. But then the pandemic came, and there is one flaw in most of that data, and that it's basically backward looking. You look in the rear mirror and you find out how the economy did in the past. It's actually a good timing that we're having this webinar today. Today is the 30th of June, the last day of the second quarter, but it probably will take another 6 to 8 weeks for us to find out how the economy did in Q2 when we wait for GDP data, because that's how long it takes central banks and statistics offices to aggregate the data and to publish it. So during the pandemic, there was obviously the need to use different data sources to have a bit more real-time information. And on the left-hand side, you see some of the data sources that were used by economists to get a better idea of what's happening in the economy, rather than waiting for GDP data or unemployment data. Mobility indices produced by Google were used, road toll data. I remember Dun & Bradstreet trying to build a model for the state of the retail sector in the US. And one of the ingredients that was used was satellite data for car parks. So my colleagues looked at, is the car park full? Yeah, that's great, which means the retail sector is doing well in that mall. If the car park isn't full, the opposite's happening. So satellite pictures were increasingly used. Table bookings, open table, for example, that was used. Social media tracking is increasingly important, and ESG as well. There are some advantages that these data sets bring. The most important one is it's more timely. Quite often it's available real time or with a delay of a few days, and it's quite granular. You can drill in very well. But there are disadvantages. One of the disadvantages that I haven't mentioned is quite often you have to pay for it, which isn't great for economists. All the stuff on the left, the traditional data, is available free of charge. But for satellite pictures, you obviously have to pay. But the main problem is that there is no long history. You can't really say at the moment it's looking like that. That compares against this state in the 80s or in the 90s or something. That data has only been around for a few years, which makes it hard to test your hypothesis, whether it's a valid statement you're making here. I think GDP will remain the most important feature for us economists for the foreseeable future, but I also think that this alternative data is increasingly important for us to improve our models. And that is my final statement here, just to conclude with GDP. I think 2022 will be a year where GDP growth will be much smaller than expected at the beginning of the year. 2023 will be another year where the headwinds are certainly increasing. So all in all, I think we are in challenging times, and data can be the key to navigate these waters in a better way. But that's all I want to talk about today. I'm now handing you over to Sean Rees. As said, he's the Credit and Data Integrity Manager at the VF Corporation. Sean, over to you.
Thank you very much, Marcus. Much appreciated in terms of your insight. So yes, for those of you who don't know me, my name is Sean Rees, Credit Risk and Data Integrity Manager for a company called VF Corporation. For those of you who don't know who VF Corporation are, they're an internationally recognized retailer of outdoor and lifestyle brands. So you probably wear them anyway, but brands such as Vans, Timberland, the North Face, Peary, Kipling, and the list goes on. So I'm here today to talk about the risk resources that can be utilized in terms of when you are making your risk assessment. So I've got a couple of slides, one relating to financials, one to trades and payment experience, one to the economy, and then one to media. So if we're looking at this first slide, in terms of financial sources, quite often the first point of call when you're doing your risk assessment of a company or of any entity or personnel is to go straight to the financial accounts, the balance sheet, the profit and loss, the cash flow, and that often is sometimes done with your credit insurer, or it's done with a credit rating agency as well. But there are other financial sources of information that you can utilize. So the first one being customer management accounts. These would be the management accounts that come direct from the customer themselves. Often you'll find cases whereby companies are classified as micro companies and not necessarily obliged to publish their financial information. And in doing so, we don't have access to that info. So going direct to the customer and the entity, to the source, that's the one, Marcus, yeah. Direct to the customer and the source is the best way of getting that information. We then have legally published information. So using the example of a public limited company within the UK, they would have to publish their financial accounts after the close of the fiscal year end in the UK, 9 months afterwards. The reason I like to stress this one is because there are notes to the accounts that are published that the customer is forced to do. These can include various information, particularly to debts, in terms of repayment terms, specifics of who loans relate to, covenants on loans, and various specific details that we might need to know. And the reason I mention that this is particularly important is because there are cases whereby information can be missed. I attended a forum pre-COVID times for a large company called Carillion, which is a construction company in the UK, and it was the largest trading liquidation in the UK at the time. I think it was 2018, 2019, pre-COVID times. And they basically had information that was classed as off-balance sheet information in terms of their loans that they had and significant borrowings that they had to be able to keep the company afloat, pay the dividends, and keep the shareholders happy. And in hindsight, it's very, very clear and easy to see that, oh, this was going on. But at the time, unless you're looking at this kind of information, these sort of things will fall under the radar. We've seen many cases. I've seen cases whereby companies have moved shares from their equity into the liabilities with the intention of buying it back, potentially to increase their EPS. And this sort of information is the sort of things that you're not going to get elsewhere. Particularly what I'm expecting is moving forward, there'll be more and more information on the COVID supports that companies have utilized, bounce back loans, furlough schemes, et cetera, moving forward. The benefit to legally published information, in the UK, we utilize the Chamber of Commerce, which is called the Companies House, and it's free. You can also they also have free equivalents, let's say, within other markets across Europe, such as Belgium, Czech Republic. So if the information is available, then it should be capitalized upon. And lastly is interim and forecasted figures. I highlight this not necessarily because, I'm aware that forecasted figures aren't necessarily the truth, and there's no guarantee that those figures are going to be hit. But it certainly gives direction of the business. And in particular with interim accounts, it gives an indication of where the business is going to be come the close of their fiscal year. If we talk about a significant example within the UK for a large department store called Debenhams, an example which I will use later on, their interim accounts were released for whenever it was March 2018, I think it was. And it showed significant dividend payments, which resulted in the company overall having no retained profit and retained earnings. And this was sign number one that things were heading in the wrong direction, which I'm assuming many of you will already be aware of. So those are the various financial sources I would use. Marcus, if we could go to the next slide, please. The next source that I would like to discuss is something that which Marcus has already touched upon, is trade and payment data. And working from the top, internal and external payment data. This is arguably, and certainly was, the most useful at the time of COVID, particularly because it was realistic and it was real time in terms of the sort of information that we were getting externally or internally from the specific customers that we have. Internal payment data is very, very relevant. We're in a very fortunate position as VF to have, I think we have 10 brands operating within the European, the EMEA region. And because of this, we have, in theory, 10 different sources of payment data to be able to capitalize upon. So we can look for a DSO, DBT changes, spikes, troughs in terms of when customers are starting to pay. And there are obviously external sources. And in that sense, I talk about other suppliers or other competitors, information from banks, any information from other various different agencies and credit agencies that are available that will be able to give you an assessment of a customer's DBT versus the market average. Generally, customers operate as like they're entities of habit, let's say. So to change their manner of trade and the way they pay, it should be a red flag and something that should crop up. If we consider COVID, I mean, this is the main negative to payment behavior that we've seen throughout the COVID period, is that it's completely changed how and when a customer pays. We've had, I think many entities will find, not just in retail, but any sector, banking, for example, payment plans, spikes, discounts, extra supports, prepayments, the list goes on. So it's almost sort of warped the payment trends that we have in place. And only now, I'm in touch wood, I'd like to think we're coming out of COVID, but that's not guaranteed. You would like to see more of a return in terms of to a new normal of the payment experience, but with a view to the fact that COVID supports and COVID debts still need to be repaid. Information exchange, I'm talking about things like, with various credit rating agencies and various other suppliers, looking at payment circles, monitoring your customers to prompt various different alerts, from as simple as, the customer's changed location, to they've released new figures, to they've changed their name, to they've been bought by someone. And this can be as, as basic or as simple as needs to be. But obviously, without the information exchange, you're not going to know of any high risk or nightmare cases whereby, another supplier might say, oh yes, we had this customer and they were sent to legal, and I know this guy because he used to have a different company beforehand that resulted in an insolvency. Perhaps it's a Phoenix company, and the director's operating like this. Then we have general trading communications. And when I talk about general trading communications, I mean in terms of how the customer operates. So, do they communicate by phone? Is it email? Are they regularly in contact? Do they want to collaborate? How do they trade? Is it prepayment? Do they have checks, direct debits? Do they want to resolve disputes? Are they consistently postponing payments? These sort of factors need to be taken into consideration with a risk assessment. And then lastly, I have business plans. Now, I break this down into several different sections, but the list goes on if I'm being totally honest. Things as simple as location. This is the sort of assessment that we would be providing on our customers, certainly our high risk customers. So particularly if we consider brick and mortar customers, given the presence in the market nowadays. And it's about as simple as, being in the right place. I've seen cases whereby customers are located on the wrong side of a river and have had no traffic or footfall or conversion at all within their stores. I've had cases whereby customers have been opened outside of a capital city. And when you look at them on Google Maps, you can see that they're in the middle of nowhere. And then lo and behold, the store needs to be relocated. So another very, very basic, but some factor that should be considered within risk. In terms of business channel, I mean, we've got various different options: wholesale, concession, consignment, your partners, your distributors. And if we take just partners and distributors as two examples, the distributor customers that you would have located across the globe, obviously, if they're situated within high-risk countries, the necessary precautions and risk mitigation strategies need to be in place in terms of bank guarantees, standby letters of credit, prepayment letters of credit, etc. And with partners, there obviously needs to be the collaboration and the flexibility thrown in there, whether it be through guarantees and extra security for the company themselves, or whether it be, bearing in mind that a partner, they need the stock to be able to generate revenue. So there has to be some sort of give and take with those customers themselves as well. So there's a commercial perspective that needs to be thrown in. Growth and reduction plans in terms of When we start with a customer, are we expecting them to just be an average customer, and your average customer who will continue to trade and not necessarily develop and grow with VF? Or are we talking about a new customer that's going to have 25 stores within 3 years? This is significant because we need to make sure that the right strategies and the right protection is in place from the get-go, so that it's significantly easier to build upon that rather than get X amount of years into a relationship with a customer and then have to change the strategy. Is it going to be a key partner? Will there be a takeover? Is there a backup? Are we planning on reducing the level of business with the customer? How accurate is the order books are? Are we expecting to double each year on year? And then lastly, I mean, Marcus, you touched upon this point in terms of supply chain. We're only going to know what the status is of supply chain with our customers based on, our own sources as well as the customers in terms of what they need. It's been a nightmare since Brexit, and with COVID added into the mix, it's a real melting pot of challenges, let's say. But things as simple as new customs rules, speaking with the customer for their location, the problems they're facing, all should be taken into consideration when assigning credit limits and assessing a risk class for a customer. Next slide, Marcus. In terms of the economy, I mean, I won't go into great detail on here because Marcus has gone into it in significantly more detail than I certainly would have. These are the sort of things that should be being considered by any risk team realistically. The sort of things that we're looking at are GDP trends. Are we heading towards a recession? Is a particular market struggling, leading to inflation, which in Marcus's opinion doesn't look too positive right now, which isn't great. Currency fluctuations tying in nicely with geopolitical conflict and country risk. The Russia-Ukraine situation is obviously very apparent, and we're quite aware, everybody's quite aware that that's a high risk area of the world, and various other various other markets globally. If a customer, they could be the best customer in the world and be millionaires and be the nicest and friendliest and always want to pay us, but if they haven't got the means to obtain a realistic trading currency to be able to settle their debts, we have a problem. Consumer behavior could be tied in with inflation rises, the cost of living, or it could just be general interests of the clientele base. And then sector and market trends. Obviously, some markets struggling more than others, particularly in COVID. This was apparent with certain markets struggling before others. For example, Italy leading the way, and then the UK being significantly hit. And sector as well. I mean, generally, obviously, from my perspective, we only deal with retail, but the other sectors such as construction and hospitality, restaurants, hotels, were obviously significantly hit. And then lastly, macro and microeconomic trends that Marcus touched upon. But all of these points are tangible. The pictures that I put down, the sale picture represents the CVAs, so the legal cases that we had, in particular in 2018, 2019, particularly in the UK, we had lots of administrations and landlord disputes, let's say, with the fall of the high street and online retail really starting to boom. We've had Brexit, which doesn't really need any introduction, nor does COVID-19 in the significant impact it's had on the economy and our client base. Russia-Ukraine, which doesn't seem to be resolving itself any sooner. And then the last picture should represent the cost of living. And obviously whether the customer and the client base is able to help drive revenue for our clientele. And then my last slide relates to the media. I added this slide in because I think the media, and in terms of tracking news and press, is particularly important in risk assessment. We utilize Google, something as simple as Google Alerts, whereby you ask Google to send you a link for any web pages that have been created or any articles that have been created, which contain one specific word. And it's very good. But AI is not yet at the level whereby you can ask Google to send you an article that says Amazon is having a sale versus Amazon is for sale. And one type of those articles would be very interesting. The other one, unless it was Christmas time, would not interest me at all. So media is a key driver in terms of risk assessment and in terms of trying to anticipate what's going to happen tomorrow, yesterday. And the example that I wanted to use was Debenhams, which is was a significant department store within the UK retail market. And what I've got here is a timeline of all the various different quarters, Q1 2018 being from January 2018 to March 2018. And it's basically a timeline of all the things that were reported in the media. So you don't actually need to be following the financial assessment, doing a financial assessment. You don't need to have the monitoring. Well, you need the don't necessarily need monitoring in place as such, but you need alerts. You know, and it's quite clear that 2 years from the actual demise and the very end of Debenhams, people should have been aware of what was happening. The signs were already there. So they started off with various profit warnings in terms of the performance of the business. They had a difficult Christmas. This then led into the financials not being particularly great. Like I said, they had released their interim figures, which suggested that the company was struggling for cash. And if you followed the news online, they were trying to sell assets. They had a Scandinavian company called Magasin du Nord, which they were trying to offload to get a significant cash injection into the company. This was followed by the chairman leaving, calls with between suppliers and this specific retailer were, I wouldn't say they were challenging. You know, the retailer Debenhams themselves were having to fight off all this negative press. They didn't quite have the financial situation. They didn't know what was going on, but they couldn't do much with it. Led to, in Q4 2018, they had credit insurance pulled out. So Atradius, I think Euler Hermes as well, various other big players within the market had pulled out, given that once their business plan was provided. And in the turn of the year, they had another Christmas period, which was mixed in the sense that performance wasn't great. They had profit warnings, share drops, refinancing plans did come through. And Mike Ashley, for those of you who are aware, he used to own Newcastle United Football Club. After just offloading them, he owns Sports Direct and many, many, many other companies within the retail sector. He's quite a big name. And he was circling and ready to pounce, is how I would describe things. He was unsuccessful though. This then led to a pre-pax administration. They had the new entity set up, selling Newco. And this just continued. It continued to spiral. There was the legal challenge by the landlords on the administration cases. And by the next calendar year, they had the administrators on standby, and then Arcadia collapsed. So that's Topshop, all the other retailers within that group. They ultimately collapsed, and they were responsible. I want to say it was about 5% of their concessions that they were responsible for as a whole. Basically, it was as we say in English, the straw that broke the camel's back. It was just the last event that could have happened, and that resulted in Debenhams' demise. But as you can see, considering this full timeline, the signs of this collapse were there 2 years ago. If people had been monitoring the news and monitoring the press and monitoring what's going on, you didn't need to look at the financials and you didn't need to necessarily look at the economy. You just needed to be tracking the articles that are related to this specific customer to know that there was a problem, quite a significant problem. And I'd just like to round off on just a slide for this, but in terms of all of this various different information, this different data, it's important to be able to score your customers and be able to enter some sort of classification in terms of, to suggest this customer's high risk, this customer's low risk, and so on and so forth. We utilize a system called Debitex, which allows us to create a score class. And what we can do with that score classification is we can incorporate a financial assessment through like a financial scorecard and payment data in terms of how quickly the customer settles their debts. And then various things that are called soft facts. When I say soft facts, these are like, how do I describe soft facts? Non-statistical measures, I would say. So questions such as rate the customer's level of communication on a scale of 1 to 10, 10 being good, 1 being bad. And what it would do is it would factor in lots of different questions and soft facts, and it would eventually spit out an overall risk classification. So when you're doing all of this risk assessment and you're considering all of these various different factors, it's important to make sure that that's well represented within an overall classification for whatever recommendation and whatever projection you have with a specific company moving forward. On that note, Marcus, I will close my section and hand it back to you. Thank you very much.
Thank you very much, Sean. I learned that our jobs are very similar. We both look at economic data, we both look at political events, we both look at credit developments. Obviously, the focus is slightly different, but that is something that I had learned in my previous role at Dun & Bradstreet, where I was the chief economist in the end. Everything is interconnected. You can't really forecast economic developments without looking at the corporate side of things, without analyzing are companies paying their bills on time, and you can't do it the other way around either. You can't really talk about the payments performance side of things, the business failure side of things, without analyzing if there is an election coming up, and this guy has promised to introduce certain laws that is impacting
very true
the free movement of capital. So everything's interconnected. We're moving on to the next topic, however, which is a slightly different one. We're talking about, or we're listening to Maria Alzemni, who is again the VP of Data Acquisition and Partnership at Dun & Bradstreet, talking about ESG. Maria, over to you.
Thank you very much, Marcus. You can already go to the next one. It is true. It is impossible to evaluate a company or to assess the risk and the level of risk of a company without having a more holistic view. And this is where also ESG data come into the play. Marcus has mentioned it before. Consider how many new different risks are appearing. We are experiencing the last years. The supply chain heavily disrupted, energy shock, geopolitical risk, climate change impacts. And all these factors are impacting the financial results of our company. Now, ESG is important because ESG ranking, ESG scores capture this complexity and assess the sustainability of a business over time. The first adopters and still now the front runner of adoption of ESG data is the financial sector. We have got very interesting examples of banks like Deutsche Bank, for example, offering prime rates for companies that have got virtuous ESG scores. We have seen that green bonds, the last that I've got in mind is Alphabet, for example, or Microsoft have reached premium prices. And also in the process of IPO, in the process of listing, more and more markets require the disclosure and positive ESG indexes. We have seen it in NASDAQ, we see in many other stock exchanges around the world. We can go to the next slide, Marcus.
Sure.
So what this says is that possibly is it not true anymore that that is the regulators that are pushing the adoption of ESG data, as we see also the market is playing. On the other side, we have to acknowledge that disclosure obligations are rising, I would say scaling up very fast. Imagine that 95% of the regulations that we have got today in place have been issued in the last 10 years. And the last but not least, with a lot of influence, I would mention the non-financial disclosure directive in European Union, the new guidelines by the European Banking Association, and in US, the Task Force for Climate-Related Financial Disclosure, led by Janet Yellen. That is a very big priority for the Biden administration. We can go to next one. So on one side, we have got the market pushing. On the other side, we have got the regulators putting on more obligations. What is today the position of the companies that have to disclose their ESG data? Well, out of a survey of KPMG, we have seen that only 13% of the companies declare to have a good control and a good overview of the ESG performances of their suppliers and their customers. What companies have in majority is two order of problems. One is quality and the other is how to collect the data. If we go to quality, most of the data that companies are today collecting are self-declared by their partners. So they get this non-standardized information to work on. So with any clue if this information is correct, what is the exact meaning of the numbers and of the declaration that are contained in these reports. And the other important fact that we have noticed, the World Economic Forum says that less than 10% of the companies are collecting this ESG data from their partners in a consistent way. So in a structured way, using appropriate tools. And Marcus, we can go to the other one. So with this scenario, DNB has decided to come into this game and has decided to work with a very comprehensive approach. Most of the information that exists today in the market covers mostly public companies. The data that we have got, the data that are used are either agency data or data from annual reports. So they're not very fresh data, as we have seen both in the previous communications. So these data are old, do not reflect the evolution during the year. So the third point is that in the ESG world, there are many different frameworks. So what the DNB has done is, first of all, putting together all the main frameworks. The second decision has been to have a wide coverage. So public company, but also and particularly private-owned companies. You can imagine that not all the suppliers, not all the customers of large corporations are public corporations themselves. No? So private information on private corporations is also important. And then use fresh data. So data that are updated at least on a monthly basis. Like, for example, news. As we have seen before, the payment data that we collect at Dun & Bradstreet with our global payment program. These are important data. If we go further, Marcus. So we have decided to have a comprehensive approach. We have put together the result of many frameworks. How does it work? So we have divided our scores in 3 specific areas, which are the component of the ESG, so environmental, social, and governance. Within each category, we have covered 11 topics. The topics is, for example, natural resources in this slide, or human capital, corporate governance. And within each theme, we have covered 31 topics. A topic is like energy management, labor relation, business ethics. And our scores are in a way hierarchical scores. What does it mean? That all the topics are weighted and go into the calculation of the theme score. So the energy management, water management goes into the calculation of the score for natural resources. Or the theme scores goes together into the calculation of, for example, the environmental score. And the environmental, social, and governance category are used to build the overarching general ESG score. Why is this important? It is important because starting from a general score, every user can go as deep as a topic level and can evaluate what is the impact of each variable into the final score. For credit management purposes, this is interesting because you can use any of these variables to complement your credit risk, to set override rules in your decisioning workflow. but you can decide which of these level to use. I mean, an American company, an American manufacturing company working with China will probably be obliged to use heavily the human capital. A chemical company possibly will have more interest in working on environmental compliance. So with this score architecture, we get transparency to the user, but also a lot of modularity. If you go one more. What data are we using for that? And what is the methodology that we are using? We are using DNB assets, so all the data of DNB Data Cloud. We are using public data sources. We are using third-party data, like, for example, payments, like, for example, financial receivables, and other data that we systematically collect from our partners. And we are using news. So all these different categories of data are passed through the filter of the usual DNB quality control. And once they are normalized and weighted, they go and into the calculation of the different level of scores. We can go one more. I said that at the beginning that ESG scores, although they seem quite vaguely related from the operational day-to-day credit management activity, they have got quite an interesting weight, but they are also quite interesting signals. We have checked the ESG rankings, and we have validated these models against the data from 3 to 5 years before. And we have found that there is a very clear positive correlation between ESG scores and growth of sales. What does it mean? It means that a positive ESG scores correlates with good economic result regularly for the public companies, but also for the private companies. And on the other side, a negative or not so good ESG ranking correlates with a negative sales and growth performance. This is the basis. So, and as I told you, we checked it with 3 and 5 years back. This means that are also a very nice signal of mid-term resilience of a business. We have also tested different things. I've chosen these two because I think they're very interesting. I chose the theme of supplier engagement. The supplier engagement means a good relationship with the supply chain. Also, this theme correlates with good results. So once again, even going one level down, we find a positive correlation with financial results. And the same thing is in corporate behavior. In corporate behavior, possibly we could have expected it because an ESG virtuous company is a company that makes a responsible use of its resources. It's a company that has got good investments to renew and to upgrade its infrastructures or its working materials. So this is what I wanted to share with you. And of course, for any question, I'm available to you. And I give you back the word, Marcus.
Thank you very much, Maria. She has already mentioned it. If you have any questions for her or for Sean, me, Paul, please use the Q&A function in Zoom. And after Paul's presentation, we will then address your questions. That brings us to Paul. Paul is the CEO of the Credit Info Group. and he will talk about real-time commercial banking information with a focus on Africa. And when I was still in the country risk world, it was always a nightmare to cover Africa because data availability wasn't that great. The data series didn't exist. It was published with an immense delay. So I had a look at Paul's slides. I'm quite interested in what he's going to tell us. Paul, over to you.
Thanks a lot, Marcus. Yeah, hopefully I'm going to tell you that things have changed. Things are not perfect, but things have definitely changed a lot. Perhaps moving on, just a brief introduction of credit info. So, we're very much, I guess, more typically associated on the consumer side of credit risk. We run businesses that are probably similar to Equifax, Experian, TransUnion in the UK as primarily our background. Perhaps moving on, we've got a footprint in Europe, mostly in the Nordics, but then we've expanded quite considerably across Africa with the biggest footprint of credit bureaus in Africa, which is moving on to the next slide, where I'm going to focus today. And certainly this footprint has primarily been developed over the last 10 years. It's something where we are very much engaged with supporting and regulated by central banks, and primarily looking at to support credit provided by banks and other financial institutions is the original motivation for us to build up this infrastructure over the last 10 years. However, I think today was something where over the last year or so, we've been actually thinking of, unlike, say, in the UK, where the credit bureau infrastructure is primary for consumers, we're also being shared with the banks all the business lines of credit that the banks have. So perhaps going on to the next slide. And that got me thinking, actually, there's a considerable challenge where for any, going through the list of data items that Sean mentioned, very little of those are available in Africa. And I was thinking, actually, we've got a huge amount of information about banking information. I think there was also a Q&A, which was about, is banking information still relevant? And we have a lot of the loans that are, information on all the loans that are provided by banks and financial institutions to corporates and SMEs. And so this, we have this information, which could be potentially used to supplement the information that is missing, such as you would normally go to a company's house or something of that nature to access that information. And so this concept is very much, I guess, at concept level, and we have the information, but actually we started to think about how can we make that available to perhaps, support trade, within Africa and from Africa to the rest of the world. So perhaps Marcus, moving on. And at the moment, the problem is and the challenge is that potentially European markets won't even look at Africa because of the challenges of trading, and which leaves the African markets very much unable to really trade internationally or even internationally across continent, but also within continent. So those are real challenges that are blocking trade, and in the end, actually blocking the development of those countries and the economies of those countries. So coming to the information that we have, perhaps the next slide, is around the banking information, independent information coming from the banks, timely and secure. So the next slide, please. So if you can imagine a typical credit bureau infrastructure, so all the financial institutions are providing information into the credit bureau. So whether it's on in some countries on a day-to-day basis, sometimes it's a monthly submission of information of lines of credit, of secured loans, of unsecured loans, bank guarantees, are all provided on that monthly basis and updated with the payments or non-payments into the credit bureau. Then our role within the credit bureau is to link them across company. So you can see across a company whether they have a line of credit with Bank A, Bank B, Bank C, FinTech, whichever it may be, and we're holding that. Generally within the legal environment, that information is available on a reciprocal basis. So it's only if you're in the club that you can actually use that information. So it's very much there primarily to support lending within those existing organizations. But then there is also a legal requirement, going on to the next slide, to provide that information to the business itself or the individual itself. So each individual can look at their own report and see their own score and information. And then the potential could be for that individual could then ask us as the credit bureau to facilitate, to pass that information in its original format to a third party, which could be a business in Europe or one in Africa. So this is how we, the mechanism where that information that is very much primarily there to be passed between the banks to support credit and risk management within the financial institutions could also be used to third party, but with the distinct consent of the business whose information it's about, their own report. Or it could be also relevant for a director of a company or the manager of an SME company, and that information could be made available. And that infrastructure is one that we are building at the moment. We have the credit bureau environment, but they provide the businesses and individuals access to their own, which could then be facilitated to pass that information on. So if we look at an example, we took an example where we took a typical international business credit report, and we also looked at the information as a comparison on a Kenyan company, the same Kenyan company with a small limited company. I think it was about $3 million turnover. So when we looked at that information, if we pass that on, if we move on, please, Marcus. So we saw that in both reports, there's standard information about the company details, legal status, start date, the contact information, the list of directors, the ID of those directors was available both in Credit Info report and the International Business Report. Moving on, please. But then when we looked at the some of the information on the banking relations, so we saw that there was no information, within the credit report, the Credit Info report, we saw available. We saw that there were 4 different external banks that were providing credit. We saw the payment history of those credit lines of credit and what type of credits they were, whether they were overdrafts or line. And we could generate a risk score, predictive risk score on that information. We don't hold financial statements, so that information is still missing, and it's something where we're thinking about using this portal for some self-declaration with still the limitations of that process. But then we've got the history of the turnover that's been provided via the bank, so the banks have validated that information. Also, in some cases, the collateral information is provided as part of the Credit Info credit report. So we started to actually understand that we had this wealth of information that was available across the countries where we're actually operating the credit bureau, or some perhaps more challenging or smaller countries where we're providing the infrastructure for third parties. Those are such as Sudan, Mauritania, etc. I put Morocco at the bottom because that's one of the exceptions. I think in North Africa, there is a much better infrastructure with financials and the availability of data, which is probably less available in sub-Saharan Africa. On top of that, that source of information, obviously we would, as I mentioned, we would have similar sort of information on the owners and directors, and potentially on related companies. So the same type of credit reports, and particularly for smaller companies, you're all very familiar with the strong relationship between the success of a company and the success of the owner or director of that company. We're also seeing a lot of use, and we're involved in a number of projects where we're seeing something like M-Pesa, which is the payment wallet information. So where you've got a lot of traffic through a mobile wallet, that is another form of seeing the actual equivalent of the transactional history and the turnover of businesses. And so we're working with companies like Safaricom, who are running the M-Pesa mobile wallet, to actually risk assess some of the businesses that are in Kenya, as in this example. So I just wanted to give you a flavor of, although some of the traditional information is not available, there are certainly some unique and independent and secure information that could be made available to improve global trade and support your requirements for understanding the risk of certain businesses, and obviously, developing the opportunities for those local companies in Africa. Thanks, Marcus.
Thank you very much, Paul, for that insightful presentation. Thank you, everyone, for sticking to the allocated time budget. In fact, we are ahead of schedule. That doesn't happen often, at least in the webinars that I take part in, which means we have quite a lot of time for Q&A. And I'd like to invite all of you attending this webinar, if you have questions, please send them our way. Paul, as you've just spoken about Africa, I remember when I was at Dun & Bradstreet looking at country risk, one of the countries that was always ranked very highly in a meaning of risk levels are very low was Botswana. I'm not sure how much oversight you have here, but when you look at the scores you're coming up with, where are the low risk countries in Africa in your universe? Can you say that, or is it?
I guess so. I mean,
scattered across the continent.
I think I suppose I know a lot of what we do is looking at actually who are the companies within and what's their status, because actually what we often see is that although the country risk may often be quite high, we still see there's a lot of resilient businesses that continue through struggling times. For instance, in Mali, there was a coup not long ago, but we're seeing still a growth in the credit there, and there's irrespective of what may be perceived initially as quite a high risk. Obviously, the worst end of the scale, we've still got Zimbabwe and some of the other countries, and certainly Namibia, Botswana, much lower risk. I guess a lot of their trading is with, and I guess association is with South Africa. They're also fairly mineral rich, and so that's I guess some initial thoughts.
Thank you, Paul. A question from Maria has come in. Do you think the cost of borrowing will be impacted by companies' ESG scores at some point, in line with carbon neutral strategies that governments as well as central banks have issued? So in a nutshell, do you need a good ESG score to get a cheap loan in the future? What's your opinion?
Things are going in that sense. I mean, as I brought up the Deutsche Bank example, the Deutsche Bank is incorporating ESG into its risk models. Now, possibly Deutsche Bank is an early adopter, but given the overall situation, I think that it will have an impact going forward. Definitely.
Yeah, I just to add to that, I think a lot of the banks will be looking at their portfolios, and so they will also be potentially wanting to make sure that they've got a balanced portfolios in terms of ESG. Because then that would impact their own ESG assessment. And so to get that what they may do is get to a point where they say, well, actually, certain categories of company, they probably don't want, or they would have only at a premium price over time, once they'd reached a certain level of the balance of the portfolio.
From a central banking perspective, the ECB, they have tried, one of their new strategies is to look at how they can impact on global warming. So yeah. in theory, going forward, loans that are handed out by the ECB are tied to carbon or something. So I can also see this topic being more and more important going forward.
And Marcus, when we see what are the guidelines of the European Banking Association, also in that respect, it goes in the direction of incorporating heavily, as Paul said, not only the company rating, the company ESG rating, but their supply chain rating.
I have a question for Sean. Sean, you're on mute before you answer. You have to remember going off.
Yeah.
You at VF Corporation obviously cover many markets. Do your strategies vary across these markets significantly, or are your risk mitigation strategies fairly similar?
I'd like to think there's a similar theme, but I would say it varies depending on market. I think if you're considering something as basic as payment performance, if you were to choose certain markets, if I was to say compare Germany and Italy, I think culturally there is a difference in terms of how people would operate in terms of when they pay and what would be the acceptable standard. Is that the right way to phrase that? I'm not sure. In terms of who pays late and who is, and which of the two is more expected to pay slightly later and which would be more expected to pay bang on time. I think you could take an educated guess. So I think in terms of payment performance, it is. Financially as well, there are certain markets that just don't have the scope and don't tend to publish the financials. So, or that you wouldn't necessarily have easy access to, thinking Switzerland, thinking Luxembourg, and the different strategies that they have in place and the different rules and regulations for publishing of accounts. However, I would still follow the general theme of following the economy, following the news, following the press, and still assessing trade and payment data. I think you can, in terms of payment data, you can go against market averages, but I wouldn't necessarily do an assessment based on, between intermarkets. Perhaps certain groups you could combine. Scandinavia, for example, generally their trends and their behaviors are quite similar in terms of how they operate and the way the countries work, but I wouldn't necessarily say that we have the same strategy implemented when we're comparing market to market.
Thank you, Sean. I have a question from a former colleague of ours, Maria, a former DNB colleague, Lindsay. Hi, Lindsay. It was a pleasure to have worked with you over the years. And this is a question regarding ESG. The question is that when she left last year, only for a certain amount of companies, news were pulled from an ESG perspective. The question is, has that changed now? Are more companies now screened for the ESG news feed, or is it still a limited amount?
Absolutely. As you know, Lindsay, having been in this business for a long time, it is a long run. So every day we increase our coverage. 3 months before, we had the coverage 27 million companies. 3 months after, we are 35 million companies covered. So we are continuously increasing, and as has been many times highlighted, media, it's a very important piece of information, and I agree very much with Sean with a strong predictive value. That is also why we are putting most of our effort in getting this coverage growing and partnering with more media partners as well. So I don't have a number of the coverage of news, so I don't know how many companies are covered, but I can tell you that it's an increasing effort to increase this database.
Thank you, Maria. Hopefully, Lindsay, your question is answered. We have another question. It could be one for you, Maria. It could be one for you, Paul. I read out the question and then you can decide who wants to answer it. What type of political data, especially in Africa, are you considering for your work, basically? So I assume that means ESG as well as your work, Paul.
Yeah, I'll let Maria go first on the ESG side.
We are not specifically collecting political data. We are normally collecting data that refers specifically to companies. So there are not so many data on political situation. It is true that we include the country risk and this kind of index that we calculate internally. For Africa in particular, I cannot answer this question. At this stage, Africa is not covered by our ESG's rankings, so it's something that is in the process.
Yeah, and I would say that at the moment within the credit bureau environment, we're not collecting political data related to businesses or individuals. Yeah, I guess the only area that we're collecting, we're actually collecting or using third parties really for our customers and providers that we're interacting with directly, not the bank's customers.
Marcus, if I can add just one element, I interpreted the question as a macroeconomic, so a macro political data. What we instead do, of course, we have got a complete screening for people that are political representative that we consider exposed persons. So in this respect, we have got a screening, but not as a political, not this kind of political news.
Thank you, Maria. Thank you, Paul. Maybe from my side, a bit of information on the political information or data that is collected. Of course, I no longer work for Dun Bradstreet. I was with them for 11 years, so I still feel confident talking about that. The company covered 132 countries. In Africa, I would say 20, 25 countries had a country risk score, and the political data that fed into that score mainly came from big surveys like the World Bank Doing Business report, the World Economic Forum's report. There is a lack of data. There's no doubt about that. And that was always the trouble when you had to cover African countries. There's another question for you, Maria. I knew that ESG would be a very popular topic. The question is, are corporations between companies and regimes that violate human rights evaluated in ESG indices?
Absolutely. As you know, it is one of the categories that goes under social. For example, under the social side, both violating rights as in the labor and also physical violation. That is very important because there are stringent regulation in some of the countries that oblige us to monitor that. And data coming from NGOs are also part of the sources that we are using in the ESG scores.
And as we're on the ESG topic, Maria, another question for you. If you subscribe to the ESG products that DNB is offering, can you have your scores monitored? And can you get an alert to inform you that they've changed?
Both. So you can have the scores of your portfolio monitored, and of course you can have your own score monitored. Definitely both.
Thank you. Sean, there's another question for you. You mentioned banks and other suppliers as sources of information. Is this still common in modern credit risk assessment? Are some countries more accepting of this data exchange than others? Shall I repeat that? Or?
Yes, please.
You've mentioned banks and other suppliers as sources of information. Is this still common in modern credit risk assessment? Let's break it into two. There's another question. Let's do that first.
So, yeah, I mean, I wouldn't necessarily say you'd be able to get a lot of information from banks on their specific clientele in terms of their repayments of specific loans and things like that. That sort of information you would only realistically be able to get either from the customer themselves or the public information that's shared within the local chambers of commerce in terms of repayment terms, covenants, whatever sort of implications sit with that sort of debt. In terms of other suppliers, I mean, speaking on behalf of as a retail, I attend forums where I can to speak with those other people that operate within the sector, particularly within retail, be it credit rating agencies, other suppliers, etc., etc. And I mean, it's still common practice. It's word of mouth, but obviously sometimes it's specific evidence and real life events that have taken place. I would still say it's very much a relevant, very much, what was the phrase, common in modern credit risk assessment. Obviously not all information, certain information has to be kept confidential for obvious reasons. But in terms of the general understanding of how a customer might operate and might perform and the history that they might have, I would still say, yes, this is shared.
And are there some countries where this is more common than in others? Can you talk about that out of your experience?
Yeah, I mean, from my experience, I mean, if I use the UK as an example, it's very, very common to have those kind of forums. I've attended some within Europe before, whereby they do share that kind of information. But to be honest, I haven't attended many. I can see Maria nodding her head there in agreement. So
yeah. Go ahead, Sean.
No, I was going to hand it over to you. To be fair.
Yeah, we've got some countries in our in the MBA market in which this information, so bank information, is made also available to the public. One of these cases is, for example, US. In US, we have got a product. It is called SPRI, and this product is run under a consortium. So for all the lenders on one side and the industrial corporations that are sharing their data within this consortium, they can have access to an aggregated index. So scores created based on financial financial receivables. In UK, we can also give with a certain coverage enhanced scores, so scores that take into account also the influence of financial receivables. And the same thing we can also do in the Nordics. So we cannot share directly, of course, the banking data, but we can use the banking data to give a more 360-degree insight on the credit worthiness of the company.
Thank you. There's a final question that's about inflation. So I think I'm going to take this. Inflation is causing problems for governments and their popularity. Do you think they will do anything to help businesses? As I seem to say, inflation will only drop when companies are growing. I think the last 2 years have shown quite nicely that governments are willing to do a lot to help stimulate the economy. So I think there shouldn't be any doubt that if the economy decelerates further, if the labor market deteriorates, then I think the government will take action. I can give you an example here in Germany. I've moved back from England to Germany last year. The government has reacted to that high inflation. They've temporarily cut duties on petrol. They've introduced a heavily subsidized train ticket. So in theory, you can travel from the Austrian border to the Danish border for €9 a month. If you travel in slow trains, so by UK standards from Cornwall to Scotland, you have to stay in slow trains though, and that is very popular and it's working. Actually, yesterday the inflation figures for Germany were released, and against the European trend, inflation in Germany dropped this month, and that was only because petrol got around 15-20 cents cheaper per liter because of that temporary cut, and train travel got cheaper. But obviously, this is a one-off method. It will be phased out in September, and then inflation will just shoot through the roof again. So overall, I think governments are willing to take action. The problem this time, however, is that the refinancing costs of governments, they have gone up. Interest rates are rising, which means that yields of government bonds are rising. This is already causing a concern in the Eurozone, as the spread between German yields and Italian yields and Spanish yields and Greek yields, they're coming back. We're nowhere near Eurozone crisis again, but it's certainly something that is causing a headache for central banks. In the UK, obviously, you have to keep in mind the political agenda of the government. If they are more on the center right or right of the political spectrum, handing out too many benefits for companies and households, might not be in line with what they want to do politically. But again, we've seen during the pandemic that these political preferences might be thrown overboard very, very quickly. Just checking if we have another question. Yes, another question came in. I read it out, and then whoever thinks is in a good place to answer that, please jump on it. Are trade references worth the paper, considering that credit applicants only provide vendors and suppliers which they pay on time as trade referees?
Depends what you collect. I mean, when we collect payments, we collect paid and non-paid, and we always collect the whole ledger. We don't want the partners to select only one part of their portfolio, because we know that this can influence the scores, but it's not real in the evaluation of their portfolio.
Thank you, Maria, for answering the lion's share of all the questions in today's Q&A session. I wrap this up. I want to remind everyone that this meeting has been recorded, so it will be made available shortly. You can forward it to whoever you think might be interested in it. We will also provide you with an executive summary and the responses to the Q&A. If you aren't familiar with the burgeoning homepage yet, I invite you to visit the homepage, especially the Global Outlook section. There's a lot of content there, thought leadership pieces. I've, for example, recently written a paper about the impacts of inflation on the corporate sector. There are more microeconomic papers about the state of certain sectors in certain countries. If you want to stay informed about that, you can connect with burgeoning as well as me on LinkedIn. I want to thank all of the panelists today for their participation. I want to thank all the attendees today, and I want to wish you a nice, pleasant evening. Thank you very much. Have a good rest of the day.
Thank you very much.
Thank you very much.
Thank you very much.
Bye-bye.
Bye.